Welcome back, traders. This week, I'm zooming out for the week ahead video to frame the big drivers, then drilling into sectors, flows, and a short list of trade ideas. We have PPI, CPI, and a sneaky important set of non-farm payroll revisions that could shift the rate path. I will show you how that maps to housing, home-related consumer demand, and a couple of stock setups I like for both momentum and pullback buys. Let's get into it. Today's plan, we're going to go over some macro and pretty simple English, try and give you guys a better understanding of what's going on. Why tariffs matter for CPI, PPI, and the bond market. The housing flywheel if rates step down. Fund flows, CTA positioning, and what institutions are actually buying. Names and levels I'm watching this week. And some key economic dates that can move the tape. All right, so what we're looking at on the screen here is a screenshot of the Fed Watch tool. All this shows us is what the market's pricing in for expectations going into the Fed meetings. Right now, our target rate sitting about 425 to 450. And as you can see, for September's Fed meeting, the market's pricing in is 0% chance that we'll be here. So we're going to get a cut. There's a 92% chance that we get a 25% or 25 basis point cut and 8% chance that we get a 50 basis point cut. So the market is leaning towards rate cuts into year end. Let's think 25 basis points in the near term and roughly 50 basis points by November if this current path holds. The tone shifted because productivity and growth have been better than feared. GDP has run hotter, and GDI, which is gross domestic income, not a lot of people follow it, but it's pretty important, is also firm. Put those together and you have a backdrop where the Fed can step down without signaling a recession. That profile rhymes with the mid-90s more than the post-GFC pattern. It will not play out in a straight line day to day, or even this week or next week. These things take time. It is a glide path story, not a Tuesday story. Translation for your book: a gentle cutting cycle with still decent growth tends to favor cyclicals with balance sheets, quality tech that can compound without chasing, and any industry that benefits from cheaper financing. So think home builders, solar, consumer cyclicals, anything that benefits from having lower rates or with consumers having more cash. A chart I found while doing my research this weekend was this one, and I thought it was pretty interesting. Just showing that GDI was boosted by public sector tariff revenues without visible offsets elsewhere. Everyone thought as tariffs got implemented and increased that we're going to lose income. Complete opposite happened, as you can see here. We didn't lose income anywhere, and all we've done is increase the tax receipts. Let's go a little deeper into tariffs here. Here's an overlooked piece. Tariffs have quietly become a massive revenue faucet. If you plot rolling tariff receipts, such as this chart here, you can see a steep change from the historical 100 to about 150 billion zone to a current pace that analyzes much higher. There's a live legal question on how durable some of these measures are. If the program is forced to roll back, the budget hole would be large and sudden. That would stress treasury supply, push yields higher, and hit duration across the curve. That is a tail risk worth flagging. Let's take a look at the 1-year PPI chart and how tariffs and other things get passed on through PPI and CPIs. Near term, the pass-through hits producers and consumer prices first. Tariffs will show up in PPI and then bleed over into CPI as companies decide how much to eat versus how much to pass on. We also saw a rush in containers shipping out of China, which likely front-loaded some price pressure. If that surge fades, you can see PPI cool first and CPI follow with a lag. But if PPI stays hot, CPI will have a harder time disinflating. That is why PPI arriving before CPI this week matters. If PPI cools, equities can squeeze higher because it validates the cut while growth holds story. And that's what's most important. We need to make sure that the Fed is cutting for growth and into productivity increase and not cutting because of a weak labor market. Bottom line here for traders, PPI will be the early tell. CPI is confirmation. Watch the month-over-month core prints. If those back off, cyclicals and rate-sensitive groups should catch a bid. We're going to get some data this week on non-farm payroll revisions, and these are pretty important. Here's a look at the 1-year non-farm payroll chart. And non-farm payrolls have been noisy, and we know revisions are coming. What I care about is the unemployment rate relative to longer run estimates. Whenever unemployment drifts above those longer run levels, the Fed will cut. Not every time on the same cadence, but that pattern has held true. We also saw an uptick in unemployment among younger workers entering the job market, which can nudge policymakers toward an easier stance. These are the people that are coming out of college and eager to get into work. The Fed usually takes that as a pretty good signal that they need to cut rates. This supports the broader case for stepping down policy rates in the months ahead. Let's get into a little bit about the housing flywheel if mortgage rates step down. We're looking at a chart that Apollo put out this weekend. on mortgage rates weighing on housing demand. And as you can see, the 30-year conventional mortgage rate up here in green and the effective rate of interest on mortgage debt outstanding, the blue line down here, has never had this kind of disparity in the history of this chart. You see right where it started to happen as well, right when they started raising rates faster than they ever have in history. So, what does this mean? It means people are locked in. If rates step down, mobility unlocks. Transactions will pick up, refis return, and an entire chain of spending turns back on. Think beyond home builders here. Home construction ETFs like ITB benefit, but so does anything tied to the move in and upgrade cycle. Appliances, furnishings, flooring and tile, paint, tools, small remodels, home insurance, even consumer credit originations. If you believe in a gentle cutting cycle and no recession, that cluster should trend higher over the next leg. My approach: let's be selective. Respect the near term extensions and look to buy pullbacks into rising 20 to 50-day moving averages or into option put walls that have been stepping up. Another chart I found this weekend while doing my research was this one that B of A put out on the CTA positioning. There's two signals here that I'm watching. First is the CTAs and trend. Systematic funds are heavily long equities. Bank models that track CTA triggers show very few sell levels near price and broad long exposure across timeframes. Could that set up a contrarian fade? Sure, but I don't fight it just because it's crowded. I use it to size risk. Crowded longs can trend a lot longer than feels comfortable, but when they turn, they move fast. Keep your stops and your position sizing honest. Second, weekly fund flows by category. Institutions have been rotating capital into healthcare, materials, financials, and gold. On the flip side, they have been trimming crypto linked funds, small cap growth, and high octane momentum baskets. Buyback data shows the largest buybacks as a share of market cap in industrials and a meaningful pickup in consumer discretionary. That tells you where corporate boards see value and where earnings durability might be underestimated. So, what's the actionable takeaway from this? Healthcare materials are seeing both flow acceleration and capital commitment. Financials benefit from a steepening curve if the front end falls faster than the long end. Gold and miners gain if real yields ease or if a budget scare nudges hedging demand. Just a quick reminder before we get into the next part of the video, none of this is financial advice. It's just how I think about structuring risk for the week. I use option walls as context, not absolutes. If a stock is below a call wall and keeps failing there, I avoid chasing breakouts until price proves it. And again, none of this is financial advice. I'm just sharing it to educate and walk you through my processes. Now let's get into some charts and some names that I'm looking at for this week. Goldman put out a report on Broadcom that I read this week, and it went into how the story is shifting from pure compute to networking, switching, and custom silicon. Estimates for AI-linked revenue have been moving up for next year and the year after. Historically, AVGO can mark local tops right after a monster run, then consolidate for months. We've seen in the past where earnings will pop and it just fades, and typically the rest of semis follow, and all of tech for that matter. But this time, I don't know if it's going to play out that way or if it's going to be different. My plan is to buy strength only on confirmed closes above heavy call wall zones. If price retests prior breakout levels, I prefer call debit spreads to define my risk. More specifically on AVGO, you can see the massive volume we had on Friday after the earnings report, and you can also see how the MACD flipped down here. I don't want to just blindly buy this breakout though. I'll be looking for pullbacks into specific zones or put walls. Other things to keep an eye on related to this are names like Western Digital, WDC, or Seagate, STX, as storage demand piggybacks the AI buildouts. I prefer some pullbacks into a rising 20 days with volume support. I really like these memory names here, as these hyperscalers are forced to buy more and more memory because they cannot just pop up a new data center every week or every month. These things take years to build. Instead, they just need to buy more memory so that they can continue running the data centers they have. I really like this trade we had in the community on WDC. Back here, they had a great earnings report and you had this big green candle. We marked the top and we marked the bottom. As you can see, we were patient and we just let it build right in here. It got tighter, kept building. We were waiting for it to either break down or break above. We were obviously looking for the break above with our sentiment on memory and the AI buildouts. So once it did, we let it get above, we let it close and confirm, and we actually waited for it to come back down and retest these levels. We had a beautiful entry down here, and we've been riding it ever since. Something else to keep a close eye on here is the second wave data center enablers. Think power management, thermals, optical interconnect. If you have a favorite here, treat it like a trend trade with a wide stop under the last high or low. If we take a look at some of the mega caps, Google's constructive on higher time frames. Chart's looking pretty good. I prefer to buying dips near stepped up put walls or rising 50-day moving averages, not breakouts into fresh call walls. If we take a look at Microsoft, zoom in a little bit here, We had this key level here at 500. You can see it was resistance where it tested, finally got above, came back down and retested and held, and was off to the races. Then that previous resistance became support, tested it and held, tested it and held, and finally on Friday, looks like it broke it, closed below. With the put wall also walking down, it suggests we can test lower support before the next leg up. For me, that means that I'll be patient rather than forcing entries mid range. I'm looking for Microsoft to go lower unless we can get some kind of confirmation reversal. If we take a look in the video, you can see we came back down and retested this previous resistance and support level from July. We hit it pretty spot on Friday and bounced, but let's see if it holds. I'm going to need some more confirmation. We've had multiple down days in a row, which shifted the options profile lower. Three bounces as guilty until price reclaims and holds above this breakdown area. Now let's take a look at housing and consumer linkages. ITB and XHB had great weeks. I like these on pullbacks, but not chases. A 2 to 5 day fade into rising support is ideal. I'll also be looking at high quality discretionary. Things like AEO, WSM, or similar retailers with recent margin expansion and guidance raises. Post earnings bases that hold their gap often trend for a while. I add on flags rather than chase day one moves. You can also look at biotech as a stock picker's sandbox. When you see related mechanism read throughs pop, momentum can run for days. I prefer to size small, trail aggressively, and sell into the first parabolic extension. Now let's talk about Oracle real quick. They have earnings this week on Tuesday. This is an interesting one. Last quarter, the stock ran into a wall after big talk about AI demand. Since then, the networking and connectivity narrative picked up across the stack. If Oracle shows bookings and backlog tied to that theme, it can surprise. My base case is a pre-earnings pin between obvious put and call walls, then a vol crush. Tactically, I like owning a call spread financed by a smaller put sale, only if I am comfortable owning a gap down. Adjust that to your own risk tolerance. You can also see on Oracle, if we zoom in a little bit here, the RSI is starting to bounce and head back higher. The MACD looks like it's starting to turn and could flip. Just keep a close eye on this one as you never know how earnings will go. How I execute these trades are I pair charts with options positioning. If put walls are stepping up under price, I look for flags above rising 20-day EMAs to add risk. If call walls sit directly overhead and price stalls there, I'll scale back and wait for either a clean breakout and close or a better entry on a pullback. The goal is to lean with the tape and let the market prove me right. Let's look at the technical map for the indices. If we take a look at SPY, we tagged a well-watched resistance zone and backed off. Call wall above, put wall below. Until we break out, expect chop. My rule in ranges is simple. Buy near the bottom third, sell into the top third, and avoid the middle. If PPI cools and CPI confirms, that could be the catalyst to push through the top of the range. If we take a look at the NASDAQ, the QQQ, there's a similar story. Resistance near the recent highs with leadership rotation inside the basket. If software and second wave AI infra pick up the baton while the core AI winners consolidate, the index can grind sideways while breadth improves. This is healthy for a next leg up. Let's go over a little bit of risk management in the playbook if I'm wrong. If PPI comes in hot and CPI follows, the market will question the speed of cuts. That pushes the front end up, bends the curve, and rate sensitives underperform. In that tape, I reduce cyclicals, trim the more extended consumer names, and shift toward quality cash flows in healthcare and low beta industrials. Gold can still work if the market smells budget stress or if real yields cool later, but never treat it as a certainty. Stops matter. In crowded trends, the first pullback gets bought, the second can run stops. I scale out into strength and get paid along the way. Some key dates for this week. Tuesday at 10 a.m., we get non-farm payroll annual revisions. This does not get top of feed attention, but it can shift the narrative on labor softness. Wednesday at 8:30, we get PPI. Wednesday at 8:30, we get the PPI. This is the tell for CPI. If it backs off, risk can squeeze even higher. Thursday, we get CPI. Core month over month and year over year are the focus. Bond auctions are dotted throughout the week. A smooth bid helps financials and duration sensitive equity groups. And then Friday at 10 a.m., we get Michigan consumer sentiment. The market hasn't been putting as heavy of an emphasis on this, but it can still move the market sometimes, so we're going to want to keep an eye on this. Earnings to keep an eye on this week are Oracle on Tuesday after hours. Synopsys is also on Tuesday after hours. That'll be a pretty big one. And then Adobe will be on Thursday after hours. Those are the three biggest that I'll be watching, but there are also several consumer names that help read pricing power and traffic. Now to sum it all up, markets are leaning toward cuts into year end with growth still decent. Tariffs have juiced receipts and nudged prices, so PPI and CPI are the deciding cards this week. If inflation cools, the housing flywheel starts turning, and consumer linked names tied to the home can lead. Funds are rotated into healthcare, materials, financials, and gold, while trimming the froth. I'm leaning along those themes on pullbacks and being patient on tech breakouts that still have call walls overhead. If you found any of this useful, please consider sharing it with a friend, tapping the like button, or leaving me a comment with the tickers you want me to chart for the next video. Also, don't forget to subscribe and turn on notifications so you don't miss any future updates and any of the next videos. We talked about some strategies in this video, such as put and call walls, and a few other things that if you don't understand and you want to go into more detail about, head over to asymmetricedge.org, get your name on the waitlist so you can be on the next round of invites for the community. Thanks for watching. See you in the next one.